for joining us. I'm Nicole Valentine, the FinTech Director at the Milken Institute. The Milken Institute focuses on 3 pillars: health, finance, and philanthropy. So we're going to talk a lot about health and finance today, the health of a nation, the wealth of a nation, and whether the FinTech revolution is going to be the answer to the issues that we're seeing in our markets and in our economy. I would love to start the conversation off. We have an esteemed panel of industry veterans, innovators, and experts in the space of technology, banking, and investment. And I'd love to start the conversation off with our why, right? So why do we need a FinTech revolution? What does the revolution going to address? And in terms of our economy, vulnerabilities, issues in banking and investing, why FinTech can be a solution to some of those issues. I'd love to start with an industry veteran, Bob Diamond of Atlas Merchant Capital, former Barclays, and banking icon. So I'd love to figure out if you can give us a sense of where are you seeing the why of the FinTech revolution, and what are some of the data points and information that you're taking in this current market?
Very, very broad question, but I think I'll give a very broad answer of why we need what we're talking about here. I think beginning in 2008 with the great financial crisis, 2 trends began right then. The first and the most important was with significantly higher levels of capital required for the larger interconnected banks here and around the world. Capital levels went from 3-4% to 12, 13, 14, 15%, dramatic higher levels of equity and capital. At the same time, huge regulatory intrusion about anything that was at all innovative or new or risky. And so at the same time, we kind of had the beginning of 14 years, believe it or not, of quantitative easing, 0 interest rates, almost a Goldilocks environment for those banks from a survival point of view because of the liquidity in the markets. But what has happened in that, it just increasingly, the larger banks have become closer and closer to the government. We saw it in COVID, where the banks in the US were really organs of the government in distributing so many of the programs. We saw it writ large just a few weeks ago when the Treasury went to the CEO of JP Morgan to arrange 11 banks putting $30 billion in deposits into First Republic. I mean, if ever there was which was the government and which was the bank. And why does that matter? What's the rub? Why it matters is we will not ever see again innovation, agility, mobility happening in those larger interconnected government institutions. They are today utilities, much more like utilities. They'll get utility returns. Their investors are looking for utility returns, and their talent will be utility type talent. And I think more than ever, the innovation, the creativity, the mobility, the agility is going to happen outside the deposit-taking institutions and the bank holding companies. And I think that's the framework of why something like this is so important. And I think if I could just mention one other, and I have to give my bias here. We are investors in Circle, but why are we so excited by digital currencies? The ability to transfer institutional tens of millions, hundreds of millions, corporate institutional transactions digitally. Today, if we have to send $100 million from one of our portfolio companies on the West Coast to the East Coast, you call up your bank, it might happen next Wednesday, it's going to be a couple of points transaction fee, and it's just very, very cumbersome. With digital currencies and blockchain, it can happen 24/7 at the speed of the internet, and with blockchain, you don't require someone standing in the middle taking the toll. So I think for the efficiency of banking, it's going to be technology, and it's going to be technology like the blockchain and like digital currencies that foster just a banking system or a financial services system that is much more responsive to its customers and much more competitive.
I love that you brought up digital currencies right off the bat, I'd love to get Sanjay in this conversation. Sanjay, you have a great experience at SVB. You've been at Google. You've seen the tech side, the finance side, and where you are now. Can you talk about your why a fintech revolution is something necessary?
Sure. I think for me, it really boils down to three things, and this is why I've been in the industry for 20 plus years. One, I fundamentally believe that the human potential is only going to be unlocked if we, within the financial services industries, really innovate and continue to innovate. Whether that's in clean tech or climate tech, whether that's enabling access to capital, whether that's allowing things to be streamlined and automated, all these things allow the unlock of human potential. And we've made tremendous progress. We have a long way to go. The second thing, which is I think very current and top of mind for most of us here, geopolitical factors, the change in monetary policy, the interest rate environment, all these things are uncovering vulnerabilities in our banking sector. And we have to make some fundamental changes and overhaul certain aspects in risk management so that we're better or more resilient to what the world is in front of us. And the last thing is technology itself is a great driver. You think about generative AI, machine learning, you think about blockchain technologies, you think about cloud and compute. All these things in the last decade are going to allow us to do things that we've never been able to imagine. So those are, I think, the reasons why FinTech and innovation needs to continue to happen.
Thank you. Thank you, Sanjay. I want to turn to Gal Krubiner, CEO of Pagaya, in this conversation about AI and inclusion. I mean, what's your why? Why Pagaya? Why the space you're in?
So I want to take the same lane that Bob was talking about. And from '08, if you think about it and rightfully say, a lot of the changes in the allocation of capital in the world has happened mainly in the major banks. And what we are experiencing these days in the so-called second banking financial crisis, let it be to the mid-sized banks in the US, is not that different. And that type of changes will impose regulation, different type of capital charges, and different type of behaviors that are not just going to be imposed on the interconnect big banks, but are going to take a bigger stand at the mid-sized level banks in the US. And as we know, when you're thinking and speaking about consumer credit, about auto loans, about CREs loans, and a lot of that power, financial power that went into the economy actually came from these banks. And the why for me is that every time that something like that is happening, and therefore some kind of a pitfall that a new regulations, et cetera, is coming to fix and for a good reason, there is a new hole that is being created. And that new hole needs to be filled. And FinTech was rather successful, call it in the last few years, of being able to fill these holes. And a good example for that is from, if you ask the question, how many of Americans has actually took a personal loan online, not from a bank, before '08, before the big crisis, the numbers are very, very, very small. And post that, when became the phenomena of that, a lot of capital was flowing to that space, it allowed to overcome the gap that was created because of the need to keep the bank safe. We are in the belief that the same is going to happen in the mid-sized banks now in the US. And of course, we are in SALT here, speaking a lot about capital allocations, et cetera. And the question is how you take that capital advantage and create returns. But let's not forget the other side of it is Americans are getting access to buy cars, access for companies to continue to develop technology. So I think from our perspective, and it goes to inclusion, where 50% of the consumers that Pagaya is lending to is actually below 660. How many financial institutions in the US can say that they're helping access so much to consumers that 50% of their application or funding is actually going to a lower FICO type of borrowers? So the need is big. The ability to influence and to make a big change for people's life is bigger than we think. And in more nimble and innovative companies, as Bob said, I think that is how you're filling the gaps and the holes, especially after a big events like we have right now. The last one was '08, that is very related to the financial system.
Thank you. I mean, in terms of filling holes, right? I mean, Dan Vene, I want to talk to you about your work at, as head of iCapital Marketplace. You work with a lot of banks, asset managers. You're doing a lot of transformation in your space in terms of platforms and enterprise level transformation. Can you talk about your why and what you're seeing in your space?
Absolutely. Thank you, Nicole. Yeah, at iCapital, we've created an alternative investment platform and tied together all the various constituents in the ecosystem, from fund administrators and transfer agents and large wealth management platforms like the wirehouses and RIAs, as well as all the asset managers. We work with about 300 or so of the largest alternative investment managers in the world today. So we've developed a lot of insight into how they're thinking about distribution and their client base. And I'd love to get into more of that. But the specific question as to why is FinTech important, from the alternative investment standpoint, I would really say one thing. It's important because people are, I think, over-indexed to the public stock markets today. And I think if you actually drill down even more, they're over-indexed into a very small number of stocks that have performed very well in the public markets, while the broader markets have not performed as well, right? I mean, even if you look at just 2023 year to date, the S&P is up roughly 8.5% as of today, but the average stock in the S&P is up 1%. It's been all mega cap tech, and if you drill down, it's 6 or 7 names. And so too high a percentage of people's net worth, in some cases it's 70%, 80%, it could be 100%, are in equities. And the easy button has been buying the S&P 500 or the triple Qs. And that's worked incredibly well, right? Bob mentioned 14 years of 0% interest rates. These companies have thrived in that environment. But if you go back even further and you look at, say, the 10-year long-term chart, 50-year chart of the 10-year, it looks like a ski slope, downward sloping until 2020. And right as we started to raise rates, we actually introduced the unprecedented stimulus, $5 or $6 trillion worth of stimulus, right? So this economy, the real economy, the financial economy, has no idea what it's like to operate in an environment with a normalized interest rate and a lower leverage level at both the corporate and the personal level. So I think as those factors start to come out over the next couple of years, and it takes time, right? Houses are still at all-time high, even though mortgage rates have been up for almost a year now. It takes a very long time for these things to filter through the system. As they do, I think people are going to realize that they have too much concentration in both the public market and in potentially large cap tech in the public markets. They've been the driver of almost all the returns for a very long time now. And people should be looking at private markets. And we now have ways to, not just our company, but we have lots of other ways to get invested in the private markets. I'll leave you with one last statistic. If you look at the 200,000 largest companies in the United States, only 2% of them are publicly traded. So said another way, you're missing out on 98% of the growth in the economy by investing in the public stock market. So there's some really dramatic sort of changes that are underfoot here, and it's going to take time for them to play out. But people should be thinking more about private markets as well.
Okay, well, I'm satisfied with the why. Now let's get to the how. How are we going to transform investing in banking with technology? I'd love to turn to you, Sanjay. You give us a kind of a specific use case in your work, financial contracts. How are you going to transform the space with technology?
Sure. So the example that you brought up, 98%, is a huge potential. There's a huge unlock there. And you think about the reasons why that is. You think about the high mins, you think about cumbersome subscription processes, you think about illiquid types of forms of investment. When we think about private markets, it's a very difficult space for everyone to actually be able to access. So you have to look for tools and solutions that essentially broaden the base of investors, create access, create liquidity, create streamlined processes that reduce the cost so that private investments become more attractive. The way we're solving for this is through Nucleus Finance. No matter how the structure of the particular investment, whether it's debt or otherwise, we've been able to essentially define the standards by which a contract is created, and that allows us to eliminate a lot of the costs associated with reconciliation, automation, from issuance to transferring and trading to securitization, collateralization, and analysis. And by doing so, you're taking that cost out of the system. By also doing so, you're opening up access because you're doing it on-chain and you're doing it off-chain, and that allows the fractionalization in a way that we currently cannot do. So Nucleus Finance is focused on capital access through a set of solutions that allow for the average retail investor to get access to otherwise they wouldn't have. And that's trillions of dollars just sitting there on the sidelines that typically can't. Now there's challenges with this, but fundamentally the solution set doesn't exist. And Nucleus Finance has filled, to your point, Gal, that gap.
Bob, what's in your tech playbook?
I think there's a couple of ways that we look at this. There's certain investments, I mentioned Circle, that are very, very much around technology. Another one would be Crux Informatics, which is all about curating data, finding ways for data and data sets to be more easily used and transformed by investors. But I think what really gets me is I look across our whole portfolio of investments that we wouldn't consider tech. We invested in an insurance company called DPL. What does it do? It has developed technology in order to take annuities from the large insurance companies to the RIAs without commissions. And they've done it because they've been able to connect using technology. But no one thinks of DPL as a tech company, right? But it's technology that's allowing them to disrupt what was a very high commission, very illiquid market of how wealth managers and RIAs got access from annuities in the insurance companies. And if we can make that much easier, we can really serve that market very well. But no one thinks of that as a tech company. Or I think of Marshberry, which is the number one firm for doing mergers and acquisitions and advice for insurance brokers. The whole key to why they've been successful is they have a database from the 8,000 insurance brokers throughout the United States of how big are they, what do they serve, what are their products, how old are the owners, when do they need to sell. And it's that database and that technology there in the middle of this M&A and advisory firm, no one would think of as a tech company, that gives them their competitive edge. And so what I get a lot of fun with is applying technology within our portfolio companies, not just investing in FinTech, if that makes sense.
It does, it does. I want to turn to Dan. I mean, Dan, can you expand upon your tech playbook, how you roll out tech and you leverage it?
Yeah, so I guess iCapital is about 11 years old now. We manage about $160 billion for high net worth investors. And as I mentioned, we work with a lot of the large intermediaries on both the wealth and the investment management side. And so the first goal of our platform was just to simply remove all the paper, right? Because the paper is where you get cross-outs and scribbles in the sidebar, and it just leads to complete inefficiency for everybody. So, I mean, you're all familiar with this. You log into your banking system today. The first thing you get if you're a new customer is, do you want to go paperless, right? So that's sort of been solved for most people at this point. And now the last couple of years has been about connecting all the different infrastructure providers. And it's because once you eliminate the paper, then you need the entire process to not have paper, but you also need to all be reading from the same shareholder records. And so you can't have Excel files being sent through FTP or on people's laptops working away. You need everything to be in a more centralized database. We've developed that, and now we're bringing that into a distributed ledger format, and we've started a consortium in that regard with some of the largest banks and fund sponsors as well, just to get initial industry support. But the challenge is not really getting the Blackstones, Carlyles, KKRs of the world to adopt it, because we have very close relationships with them. The real challenge is getting all the different third-party infrastructure providers, tax and audit firms, fund administrators, transfer agents. Many of them don't have the budgets to invest in large new technologies, even though the technologies would dramatically improve their efficiency. And so we wind up almost building technology that we are just looking for them to adopt, and not even doing it as a large economic gain to iCapital, but just to increase the speed, the accuracy, and the efficiency of the entire alternative ecosystem. So that's really where we're focused on now. And DLT and other technologies like this can be incredibly impactful, but again, they're only as impactful as it's like the weakest link in the chain analogy. Like, they have to run through the entire process, because the minute you go back to Excel, you're immediately out of date. You're sitting in someone's computer, and you don't have that sort of golden source of the data. So those are the challenges that we're trying to tackle now.
Great. Gal, transformation tech.
So I think for me, the biggest play of the how is a combination of two. It's on the one hand side, which is the first layer, it's the connectivity and the data, which is the infrastructure. And then the second layer of that, which really comes to one word that we all use a lot, but I think we still don't understand how powerful it is, it's the AI. If you are merging and moving the world to become much more connected, with much more data availability, and therefore to run AI on that, the things that could happen in that are almost magic. And we saw the best example that all of us are starting to get related to that and feeling that the ChatGPT, right? The ChatGPT. But this type of layering the connectivity, the infrastructure, and data moat, and then putting on that a real strong logic capabilities, is things that exist in many other places. And a lot of like the way Bloomberg is working these days are like that. And actually what we build in Pagaya, which is the AI network for lending, it's exactly the same, which we are allowing for lender to connect to a centralized place while collecting so much more data that any monolender has, and then allowing for a lot of people that would otherwise would have been declined to get an access to credit through this centralized network. So the power of AI could only be unlocked when you're using the vast majority of data that you need to be able to build the right infrastructure to collect it, which is very different than the infrastructure of tech that used to be like 20, 30, 50 years ago. But once you fix that, the actual modeling and the ability to learn is staggering. And when we're talking and what we are seeing in Pagaya is that on the same flow with the same applications, your ability to improve 20 to 30% more approvals every year just because the algos are becoming better and better is the basic. So we are talking about ability to increase the efficiency by 20 to 30% with algorithms only if you have the right data and the right infrastructure and the right feedback loop to provide all of that. So the how for me is definitely the AI, but it needs to be built on fundamentals that are suited for that type of level of algorithms in the today's world.
I want to ask this question for everybody. I mean, there's a issue around trust, trust in tech, trust in institutions. How do we build trust back into the process of the work that everybody's doing? I mean, are we thinking about that?
Well, to build off the last point and to parlay that into trust, when we talk about data, especially from the lens of AI, there is a presumption that there's massive amounts of data or a reasonably large amount of data to then infer and lead to some type of outcome. And there's a lot of ranking and evaluation in the process to power that algorithm, for example, right? But there's another model that exists, and that's the data that comes in, if it is defined, it is clear as to what the definition represents. It creates a standard algorithm from which everyone knows, every party that's associated with that particular financial contract in this case, is aware of what it represents in terms of the asset, the liability, the cash flow, the trading, the transference. It is inherent at that point, it's essentially a byproduct, that it becomes trusted because there's not a discussion as to what it represents or what it is or what it isn't. It is defined, it's calculated, and it's available for everyone. Reconciliation becomes unnecessary. Validation becomes unnecessary. Auditability is inherent. And so if you build a product with data in mind, standardize it, create an algorithm. Everyone understands it. You have a unified view of it, and therefore you have trust. So I think bridging what Gal said and this notion of trust, I think that's the direction of where technology is taking us. Nucleus Finance has started from that very premise. Nucleus Finance it's atomic. It started from the foundation of definition. And from that, we feel that we can go after a $50 trillion financial contract industry. But that's the starting point.
Nicole, you hit on a very important issue. I mean, it's at the very, very core of what's happening in banking today. Putting your deposits in a bank is a confidence game. Confidence is all about trust. We've broken the trust. And what we saw in SVB, particularly with the progress in technology and the people, so many consumers and depositors in SVB being able to move their money out of that bank so quickly, the regulators weren't prepared for that. So as soon as the trust broke down, we don't have to go through it, we've all read about it, the trust broke down, the deposits were gone, SVB was gone. It could have been for the wrong reasons. Now there were some issues there. There was some really, really bad risk management, and some of us have talked about that, but if we don't solve this, and in my mind, I feel passionate about two things. Thing one, if we end up with 4 mega banks, we all suffer. I have a small business today. I'm no longer the CEO of 160,000 people in 60 countries. I have a small business. Last week, my communication from the bank was coming from First Republic. This week, it's coming from JP Morgan. Next week, the costs are going up and the service is going down. Doesn't make JP Morgan a bad bank. They have 10% of the deposits in the country. They have trillions in capital. They can't service someone like us. They don't want to service someone like us. My daughter's business needs inventory financing. That's going to come. So one of the great attributes for our economy, and one of the reasons we recover so quickly, is we have 4,000 banks, community banks, agricultural banks, specialists in Des Moines working with small companies. And if we don't solve this by doing something about raising significantly the level of deposit insurance and recognize that the way to bring trust back is people shouldn't have to worry about their deposits. Shareholders should worry about the equity. Unsecured creditors can worry about the credit, but those people are sophisticated and can do the study. But a farmer in Des Moines shouldn't have to worry about whether his deposit is safe. So let's not just imply that they're safe for now. Let's actually get legislation, because I think this is a huge issue. And if we don't solve it, we're going to end up with 4 banks. And I don't think that serves our economy well. Dan, do you want to weigh in?
No, I think it's a really great point. And as Bob was talking about that, I was just thinking about the fact that most of these regional bank problems are stemming from lending and the wild fluctuations in interest rates, and that's just another byproduct of thinking we can manipulate our entire economy with rates, right? And it's sort of unprecedented what we've done. I don't think it is unprecedented what we've done. I don't think anyone knows exactly how it's going to play out, but the mistakes were not just in waiting too long to start raising, or now raising for too long or holding for too long, right? Because I think the mistakes are more profound than that. The mistakes are thinking that the Federal Reserve can sort of architect optimal outcomes for investments and risk assets, and I think that's fundamentally the mistake. And it's hard to have trust if you don't even trust the biggest hand in the market, right? So I think they need to take a free market capital approach to our economy.
And I'm going to give Gal the last word on this.
And I think there is something to be said about communication. I think that when we look on the banking industry in whole, and taking that to 2 parts. Every time there is a crisis like what we saw, think about even overseas, Credit Suisse in one day disappeared and became UBS. The government of Switzerland took a law and moved the law to make that happen, a shareholder meeting law. This is as crazy as one would have imagined could happen, even more in a country like Switzerland, which laws are above everything. How many times did we see someone standing in front of the camera explaining from a regulator explaining what is happening with SVB, why it happened, how they're going to treat it, and giving a clear message to the people. Just to say, we are working on it, give us time. Simple statement. When there is a terror attack, when there is something, I was born in Israel, the prime minister is going out and saying, that's what happened, that's how we're going to deal with it, give us time. When it comes to regulation and financials, no one feels that it's responsibility. So there are millions of people standing in the line to get their money from First Republican. They don't even know what they're standing there. They just saw someone else is standing there too. Communication and taking that, they understand that something there is about finance that is complex, that the simple person doesn't really understand how it impacts it. And someone taking ownership of that communication to explain what's happening and how it reacts, I think, could solve at least 80% of the trust issues, especially because we are, as an industry, and I'm including myself in the industry for a second, are so bad when shit hit the fan, not just to explain simply what happened. So in my eyes, few simple communication ways could solve a big, big trouble of like then having a 10 years of lack of trust after.
Well, we could have this conversation and keep going on, but I want to thank you all for joining us for this expert conversation on the FinTech revolution. Thank you. Can you join me in welcoming, thanking this panel? Thank you.